The mineral supercycle is here, and it's going to reshape global markets for the next decade. By 2035, we're facing a 33% copper deficit and a 38% lithium shortage. This isn't speculation, it's math. Electric vehicles, artificial intelligence data centers, and electrical grid infrastructure require 10 times more minerals than current supply can provide. Today, we're breaking down the pure plays to profit from this crisis. Here's the problem. Developing a new mine takes 10 to 15 years from discovery to production. Environmental permitting, infrastructure build-out, and capital requirements create massive barriers. Meanwhile, demand is accelerating now. Electric vehicles need 4x more copper than gas cars. A single AI data center requires miles of copper wiring. The grid needs complete rebuilding for renewable energy integration. Let's start with copper, the backbone of electrification. A 33% deficit by 2035 means we'll need one-third more copper than mines can produce. Copper is in everything: EV motors, charging infrastructure, data center power systems, solar panel wiring, wind turbine generators. There's no substitute at scale. Prices will have to rise dramatically to either ration demand or incentivize new supply. Both scenarios benefit copper investors. For copper exposure, you have two approaches. COPX is the Global X Copper Miners ETF. It holds a diversified basket of copper producers globally, reducing single company risk. If you want concentrated exposure, FCX, Freeport-McMoRan, is the world's largest publicly traded copper producer with mines in North and South America. FCX also produces gold and molybdenum, providing commodity diversification within a single stock. Lithium powers the EV revolution, and we're heading into a 38% shortage by 2035. Every electric vehicle battery requires lithium. Grid-scale energy storage requires lithium. Consumer electronics require lithium. The challenge? Lithium extraction is geographically concentrated in Australia, Chile, Argentina, and China. Geopolitical risk adds another layer of supply uncertainty, making this shortage potentially more severe than copper. For lithium, LIT is the Global X Lithium and Battery Tech ETF, giving you exposure to the entire lithium value chain: miners, refiners, and battery manufacturers. For a pure lithium play, ALB, Albemarle, is the world's largest lithium producer by revenue. They dominate lithium chemical production for batteries and have long-term contracts with major automakers. Albemarle is sensitive to lithium prices, meaning high volatility but significant upside in a shortage. Nickel is the unsung hero of battery production. High nickel battery chemistries offer better energy density and range for EVs. Tesla and other manufacturers are shifting toward nickel-rich batteries to improve performance. Nickel also serves stainless steel production, providing demand floor even if EV adoption slows. The nickel market is tight, with Indonesia controlling much of global supply through export restrictions. For nickel, you're looking at the big three diversified miners. VALE, the Brazilian giant, has major nickel operations and is investing heavily in battery-grade nickel production. NILSY, Norilsk Nickel, is Russia-based and the world's largest nickel producer, though geopolitical considerations apply. BHP, the Australian miner, offers nickel exposure alongside copper, iron ore, and other commodities. These aren't pure nickel plays, but their scale and diversification provide stability. Here's how to approach this opportunity. Conservative investors should prioritize ETFs. COPX and LIT provide diversified exposure without single-stock risk. Aggressive investors can allocate to individual miners like FCX, ALB, VALE, NILSY, and BHP for higher upside. A balanced approach might be 60% ETFs and 40% individual miners, or you could go all in on one mineral if you have a strong conviction on which shortage will be most severe. The key is understanding your risk tolerance and time horizon. The mineral supercycle isn't a prediction, it's already happening. 33% copper deficit, 38% lithium shortage, 10x demand from EVs, data centers, and grid infrastructure. Supply can't keep pace with demand. These deficits will create generational wealth for investors positioned in the right commodities. The only question is which minerals you're buying and how much exposure you want.